Bill Ackman came over the top. He's buying a ton of Netflix, and Tesla just absolutely flipped to becoming a money printing machine and had a ridiculous quarter. Revenues up 53 billion, up 71% year over year. Q4 revenue 17 billion, 65% year over year. And they increased their deliveries by 71%. And now you're all of a sudden to start to see some income coming into the company. So flipping from money losing to break even to now printing a ton of money. Microsoft had an absurd quarter. Their revenue hit 51.7 billion, up 20% in the quarter, 20% year over year. Pays for $200 billion in revenue in 2022, and their net income was also up 20+% at 18.8 billion. So the money printing machine in these companies is just extraordinary. Chamath, what are your thoughts?
I think you forgot a couple of key things, which is that the FOMC meeting happened this week, and Powell basically said, look, we're going to start tightening in March. I think the way that he said it, all of these words tend to be so scrutinized and overanalyzed, but instead of figuring out what people thought, I think their actions post the FOMC are important, which is that, we effectively now started to price in about 5 rate hikes this year. So probably 5 25-point rate hikes. Effectively, that's what the yield curve tells us. If you take a big step back, I just want to remind people, it's really hard to live through volatility, right? And we're in a phase of it now. But typically these big drawdowns, so when stocks go down, it actually precedes, so it comes before the actual starting of a rate hike cycle. And so if you go back to from 1950 onwards today, every time the government has started to raise rates or the Federal Reserve has started to raise rates, the stock markets have actually rallied. Now, why is that? It's typically that they see through the end of the rate hike cycle and they start to price the business as if these rate hikes are done and to rebase things. And on average, I think the stock markets go up between 7 and 8%. So call it 7.5%, 8.5%. And so what's interesting to me is now we're finally starting the process of these hikes. And the real question is going to be, how data dependent do these guys get? And what I mean by that is, so, we talked about this before, but, China cut rates. This past weekend, actually, Germany decreased their GDP forecast. And so you're starting to see 2 huge countries already say, hey, wait a minute, we need to be more realistic about what long-term growth looks like here. It's inconceivable in my mind that those countries are slowing down and we won't. And so I think what happens in these other huge GDP drivers of world GDP will affect us. And so, Sachs and I have said this before, but the marginal risk will be that we overcorrect and actually create a recession that doesn't need to be one. So
we slam on the brakes too hard. And another way of saying it is the rate hikes the market is a leading indicator of what's going to happen post the rate hikes.
We had a nice relief rally going until I think some of the words that Powell used was that there was plenty of room for rate hikes.
Yeah.
Meaning that because unemployment's at 3.5%, that, we're at full employment. And that means that the Fed has this dual mission of keeping inflation low and, keeping employment high. So if employment is high, then they've got more room to raise rate. Anyway, it was that language around the plenty of room that freaked markets out and it triggered a huge sell-off. I think to Chamath's point, I don't see how you can have this much wealth destroyed so quickly and have it not impact the real economy. There's a lot of people out there who feel a lot poorer because their portfolios have gotten slashed in value. I mean, anybody
so they'll belt tightening, they'll clench, not spend as much money on a vacation, not buy a TV or a car. So these wait lists for cars might become sales.
The luxury markets of the economy, the optional purchases start to really slow down. And so I think that the risk of recession now is much higher than it was even a month ago. Now, it's going to be hard to know. So basically, I think what we're saying is it's going to be very hard for the Fed to engineer a soft landing here, where we don't trigger a recession in the process of stopping inflation. And look, we'll judge Powell's performance, at the end of this. We're not going to know. I think but I think that he's turned out to be much more hawkish in his statements than markets were expecting.
Again,
That's
and in
pretty clear.
2018, he was probably overly hawkish, and he actually created effectively a little mini recession. We didn't pay attention enough to it because, Trump made it impossible to see the signal from the noise. But it did happen, and it was Powell being a little too trigger happy. And so, we have to remember that, the Fed has $9 trillion of assets on their balance sheet. And so, if they start to take $9 trillion of cash out of the system by selling these assets into the market, right? You're taking the money out, right? Because you're getting money back. That's going to have an enormous, huge impact as well. So if you think about...
Stupid question, Chamath. What happens when
let me
that
just
money
finish.
comes
One
out?
second.
Yeah,
One second.
yeah.
Let me finish, please. So, so when you have these two things happening at the same time, you have a potential rate hike cycle, which makes the cost of a used car more expensive. The cost of your credit card balance is more expensive. The obligations you have to pay just become naturally more expensive. You feel poorer, so you spend less. And then separately, in the financial markets, you actually take liquidity out of the system. And so people value, liquidity more. It becomes worth more. You value current cash more. I mean, we're putting ourselves in a really delicate position. So he's got a delicate balancing act here. He is definitely on a tightrope, I think.
So if we pull $9 trillion out, we've been talking about this deficit. If he starts selling all of those assets, does that mean on the United States balance sheet that will reduce our national debt?
No. I mean,
where does the money go?
We're getting $9 trillion of cash, right? You sell an asset, you get cash for it.
Right. And
so it pulls money out of the economy in the same way that it created liquidity when they were buying assets, right? When they were buying this debt, it would push money out. If they're selling the debt, it pulls money back in.
What happens to those dollars is my point. Like, what is the impact of those dollars sitting around in the United States bank account?
The dollar stays in the USA's bank account, but the obligation, the note, it exists in some financial intermediary that holds it.
Clearly, Powell does not want to be remembered as the Fed chief that let inflation slip the leash, right? I mean, he's gotten religion now around the idea that this inflation is not transitory, which was his position for months. I think that now bit him. And the risk is potentially an overcorrection, but he's not going to let inflation.
He'll be the first Fed governor to have caused 2 recessions.
I think it's like a serious risk. And by the way, these market levels that we're at right now, I mean, look, 60% correction in growth stocks. Okay. But this is that's still in a good economy in peacetime conditions. And now we have a risk of recession and war. So, there's still room for, a lot more negative news here is kind of my point. And, but look, sentiment's also very negative. So when sentiment is this negative, there's also the potential for markets to quickly recover.
But I think the sentiment is there for the wrong reasons. I don't think people are thinking recession. I think people are thinking, my gosh, these rate increases, my gosh, I can't own these high growth stocks anymore. And none of those things are true. Those are just perceptions that get amplified by one's emotions when you're getting punched in the face, which is what happens when you wake up every day and your portfolio is down, by the way, 5 or 6%.
It generates incredible opportunity. The idea that markets bucket quote unquote growth stocks together, I think kind of obfuscates an important point, which is that some of the businesses in that category are real businesses that are going to succeed over the long run. And some of them are speculative and are likely to fail over the short run. And, as you saw Netflix sell off, Bill Ackman, very smart, came in and bought a bunch of the stock. I don't know if you guys remember this, but in 2011, TCV, which is traditionally a private equity investor at the time, and there wasn't a lot of crossover and public market stuff happening. They were a private investor in Netflix. Netflix stock tanked from, I think it was around $220 a share down to $70 a share in a couple of months. And TCV did a $200 million pipe into Netflix. And everyone was like, oh my God, what are they doing? It's incredible. And by the way, that was on an adjusted basis, that's $10 a share in today's share price. So that $200 million investment that they made went up 60x, at the peak of Netflix a few weeks ago. And so, seeing Bill Ackman come in and underwrite Netflix again and make a big investment at its current market price.
So Jay Hogue,
I think it just really highlights that there just because the market price is down doesn't mean that a business isn't fundamentally valuable and going to grow and going to generate significant returns over time as an operating business. And that distinction starts to present significant opportunities in a market condition like this. And the businesses, we all talk about generally growth stocks are down 60%, but maybe most of them shouldn't have even been public companies in the first place. Maybe they should have been speculative private investments where more than 2/3 of them were likely to fail, and they shouldn't be failing as public companies. And the few that are getting damaged and hit with this market sentiment shift can be picked up cheap. And there's a lot of opportunity. And so I wouldn't view the market condition to be necessarily reflective, again, of the economy or the condition of businesses in general.
Jay Hoag was a partner at TCV. He's the founder of TCV that did that deal. And he's also the one that participated and led the $1 billion round into Peloton before they whiffed earnings and got decapitated. But he's an incredible investor. That trade is probably one of the best trades of all time.
So let's look in the good news column. Wages way up, earnings way up, 10 million job openings in the United States, pretty close to record low unemployment, and the pandemic ending, and people having record savings in their bank accounts and personal balance sheets. So how does all that good news...
The pandemic hasn't ended.
It's ending for people. I think it's over for people.
JK, I'll tell you the thing I'm most concerned about. There's a reverberation that persists in supply chains. I don't know how much hardware, lab, biotech, consumer goods businesses you guys are involved in. I'm involved in a number of them. Every single one of them are crippled in some way right now by supply chain issues. I mean, I'm talking about like businesses that have been operating at steady state for many, many years.
When do those get worked out?
We don't know. And everyone's getting surprised and hit upside the head every week with some new supply chain shortage, whether it's some chemical you need for some lab equipment or, the delivery of some big piece of equipment, or even plastic bottles that we use to kind of fill up our beverages that we ship. That's a pretty sizable business. We've never had supply chain disruption like we're seeing right now. I'd like to bleep out the name of that company.
Yeah, beep.
But it's a bleep this out, but it's a significantly sized business that has never had supply chain issues. It's all US based, but some of the suppliers have had complete failure in delivery. And all of a sudden it's now reverberating through the supply chain. You guys saw that GM didn't deliver a single friggin' electric vehicle last quarter because they couldn't actually get the chips that they needed to make cars. Yeah. So the real risk to the economy, in my opinion, right now is when and how we're going to work our way through the supply chain issues. And it is so complex and there's a myriad of problems and it is a global problem that it's really unclear how this is going to play out over the next 6 months. And what will happen is this quarter and next quarter, businesses that you didn't realize and didn't expect are going to get hit with supply chain problems are suddenly going to say, guess what? Our revenue's off by 20, 30% because we couldn't sell this product and half our shelves are empty because product didn't show up or whatever the narrative might be.
All right.
And
so
it's a real problem.
I think it's a great point because you don't solve these supply chain issues with rate hikes, right? It
has nothing to do with that.
Nothing to do with it. Right. So the rate hikes slow the economy
down. And that's why I'm way more worried about this than rate hikes.
Right.
What does clean it up is capitalism, the end of the pandemic,
worried.
time,
I'm less
indigestion.
Worried. Yeah. And the reason I'm less worried is when you actually talk to the companies that are spending enormous amounts of money on CapEx, they've actually guided to the fact that by the end of this year and the beginning of next year, most of these things will be worked out.
Yeah, it's indigestion.
So I think we're dealing with a 6 to 9 month issue of having turned things off and now rapidly trying to turn things back on. And we can't necessarily get that timing right. But I do think it'll work itself out faster than people expect. Personally, that's what I think. Because the cost of Apple and Tesla specifically guiding to that is too enormous. You're talking about, collectively almost $4 trillion of market cap. So they're not going to get something like this wrong. And they were pretty clear in the last few days that this will be done by 2023, early 2023.
So Sachs or Chamath, I just listed all the good news to counter, the slog and the bad news. How do you account for record low unemployment, record number of jobs, record wages going up, massive cash on people's personal balance sheet, massive amounts of sideline cash, massive amounts of venture funds being raised that have to be deployed in the next 5 years? All that good news, where does that on this balance sheet of good versus bad, work out for you, Sachs?
Well, the negatives are that, yes, the unemployment rate is very low, but a lot of people have dropped out of the labor force. So the labor participation rate is still quite low. So
because of?
Well, because I think a lot of people dropped out because of COVID,
Yep.
Everyone went remote and I think, they got these stimmy checks and I think a lot of people got used to not working,
Okay.
And maybe you had a household with 2 people who used to work and now only one of them's working. Maybe they moved to a cheaper part of the country. So, maybe it's a good thing, right? But a lot of people dropped out of the labor force and they haven't come back. And so that's the negative. And then, the fact that wages are going up is good, but we don't know how much that's inflation, right? So, those would be the negatives. But there was a report that inventory levels did rise in Q4. And so the supply chain issues do seem to be ameliorating to some degree.
Anecdotally, I was looking at cars, and now a lot of the people who had, there's no way to get this car. Now they're like, hey, we got a couple of these cars available if you want them. And then if you look at the housing inventory, it does seem that maybe that's taking a pause too, and people couldn't find houses. And now maybe, even though it's still a housing crisis, maybe there's more available, or they're staying on the market a little bit longer.
Yeah, I think it's pretty clear that economic activity is slowing. And again, things like rate increases, it increases the cost of a mortgage, right? So that could affect house prices.